How's it going, guys? This is Feeding You Information, and this is going to be my second video on finance. In my first video, I was convincing you why you should buy Kraft Foods. In this video, however, I'll be comparing Fedex and UPS, telling you which is better in the short term and which is better in the long term if you were to invest in either. Before I talk about them, I just want to talk about Amazon's new delivery service. You don't have anything to worry about these two companies failing because of it. Amazon even made the comparison of themselves to FedEx, saying we have to lease 40 planes, whereas FedEx would own 579 of them. With that being said, the reason for the delivery service is to meet the demand of one-day shipping that they are guaranteeing and trying to increase their reputation with, and it'll end up benefiting all three companies. Now, FedEx right now is down about 13%, valued at $237 a share, which is very high. Very rapidly growing company, without a doubt. It's got a market cap of $63 billion. Its PE is approaching 22. However, it's slightly below at 21.8. And it is below the market average by about 2 points. It has a dividend yield of less than 1%. However, they did increase it. It was valued at 40 cents per share. Now they've increased it to 50 cents per share, essentially $2 per share annually. Their quarter 3 2017 EPS, earnings per share, that's what EPS means for those of you that are wondering. They beat analyst expectations of 3 by giving 3.5. So every time you're buying a share, all the amount that you're funneling into the stock, they're making 3.5 times that in profit and revenues. That's what that EPS means. With that being said, the reason I think FedEx is better short term is because this year their FedEx Ground, FedEx Express, and FedEx Freight all grew in demand and profits. And their EPS, due to the tax cut that is coming, is one that Trump signed, and it's basically going to allow a lot of big blue chip companies, so basically companies with like 50 billion plus that just have a lot of overseas things going on too. It'll help cut the taxes of overseas activities, so they'll be able to get more profits and thus have more cash on their balance sheets. So because of this, their EPS is expected to grow in 2018 to 4.4 and perhaps all the way up to 5.3. So 5 times the amount that you're funneling into this company is what they'll be making in profits. I just thought that's pretty awesome. So with that being said, on their balance sheets currently, their asset to debt ratio is 1.5 times. So they have 1.5 times their assets that they do debt. So they really have that under cover. But the reason for that is because they're such a rapid growth company. So they need to maintain that. That's the dangerous thing with the value of this company and the $237, approaching $238 per share. Right now they have $4 billion on their balance sheet in cash, so is a hefty amount of cash. They're doing well. That was back on 2017 though, so we're not in current time specifically. I can't exactly get that right now. What else? Here we go. All right, so sorry about that. I'm messing up my words. We're going to jump into UPS now, guys. Now, UPS is valued at slightly below $106 a share at the moment. It's down for the month almost 22%, and to me, that's a beautiful time to buy. It's absolutely cheap at the moment. It has a market cap of $91 billion, so $28 billion higher than FedEx at the moment. It has a PE of approaching 19, but 18.7, and that is about 5 points below the average, so that's doing very nicely. It has a dividend yield of 2.78, so almost 3%, and that is actually calculated out to be $2.40 per share, so that's better. And now if we take a look at UPS's EPS, then you can see that FedEx clearly has a much better one because, as I said, they are much better short term, growing in profits and everything. However, they still beat analyst expectations. Analysts expected a 1.66 and they gave a 1.67. If you take a look at their balance sheet, which I don't have here in front of me, but I can go ahead and compare it to FedEx's. Keep in mind FedEx's asset to debt ratio was 1.5, so they had double and a half their asset to their debt and $4 billion in cash. UPS had 1 times, so double their asset to their debt and $3.81 billion in cash. Now, the reason why I like UPS better long term is due to the fact of the tax cut. What is the tax cut? Donald Trump signed a tax cut, and now a lot of the missing revenue, profit, and cash that a lot of big companies like UPS and FedEx are missing is going to come back. What is FedEx going to do with that cash? I don't know. Nobody knows at the moment. So right now, the best one looks like UPS, who knows that they're going to fix up their balance sheets, and they're also going to work on expansion of warehousing and equipment, as well as the biggest thing is automation. They're going to work on putting machines and robots to replace humans, aka their coworkers, or their workforce. Their workforce is the better word. And doing that will increase their profits, as well as, it's less of a stress of saying, hey, I have a worker that might call out, and versus a robot or a machine that's all going and just automatically doing it 24 hours a day. You're all set. It's less worrisome and it's more profitable. So that's my argument for UPS long term. And that's it, guys. Here's a quick look at my portfolio currently, if you'd like to see as well. And thank you so much for watching. If you enjoyed the video, please leave a like and make sure to subscribe. This is Feeding Information, and have a great day.